Morning, Market Chameleons. Everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, good morning, D.
Good morning, Will. How are you?
Great.
Good morning, everyone. Let me share my screen here. And I think today what we'll do is cover some analytics around historical earnings for Microsoft. Microsoft's coming up with earnings, I think, today after the market closed, they're expected to announce. So let's take a look at how Microsoft stock behaved historically, how the option prices anticipated the stock to behave, and what was the difference or the error between the anticipated move or predicted market move versus the actual move. So we could get some insights. What happened historically and how did the options look like today relative to where they usually are priced ahead of earnings. So to get to that page, if you type in Microsoft up top in the search up here, you will come to the summary page. And what we'll do is go under this menu on the left-hand side, click on earnings, and you could see that there are different analytical tools for you. Let's look at the implied moves over here. Click on that. And then we come to this page. I'm going to close this menu to expand our screen. And we got some summary statistics over here to look at. And down below, what we see is, first, let's take a look at this visual. Then we'll read some of the stats up top. Here we have a historical view of Microsoft's earnings. So these are all going back in time, I think last 12 quarters. And you see these bars here, they go up and down around the 0%. And what they represent is the anticipated move from the options markets based on the straddle. Okay, so a straddle is buying a call, buying a put at the money, and the stock needs to move by a big enough percentage in either direction to cover the cost of both options to break even. It goes above that, it would be profitable. If it lands and closes inside that range, then the move was less than anticipated. So here we have the bars to show us what the anticipated move was or the implied move from the option straddles for each of these historical earnings announcements. So this is right up till right before the close of the day, what the options were anticipating. And you could see here that, they fluctuate. These bars are not always the same. Here we have bars that stretch further. Here they come in narrower. So it's not always the anticipated move could vary, right? It just depends on the people's expectations for that particular earnings, the supply and demand. And now that we see that, the question is, well, how did the stock actually do? Did the options tend to overestimate the move every time? Or sometimes, most of the time, did they underestimate the move, overestimate the move? How did the stock tend to move? By what magnitude? Did it move up, down? So all this, these are questions that we may be asking, and this one visual gives us a lot of good information here. So here, this is right now the current expected move, January 29th, after the market close. So this is the bar. We haven't announced earnings yet, but this is keeping track of the option straddle as we head into the earnings. This is the previous bar, and you could see that on October 30th, after the market closed, Microsoft reported earnings. This red bar pointing down means the stock on that day moved lower. That's what the red bar is. And you could see the magnitude of the move was down 6.1%, which was a bigger move than the straddle anticipated of 4.6%. And that's why you see that red bar going below or breaching that bracket, right? So this is the bracket, up or down, and you could see that that red bar is below it, meaning that the stock moved by a bigger percent than the straddle was implying. And that's how, in the green bar over here, for example, April 25th, after market closed in 2023, the stock was up 7.2%, compared to an implied move of 4.2%. So that move exceeded the anticipated move. So this here is a quick view or visual of what tended to, what happened in the past, to give us an idea of potential ranges. If we spot anything unusual or pattern or trend like that, that this visual can help us do that. And then we have like some summary stats here to help us out as well. So here we see that the options market tended to overestimate the move more often than underestimate. 67% of the time in the last 12 quarters, the move itself was overestimated, meaning that the option prices were priced higher than the actual move. And that's where you see these brackets, right? So here's a bracket. The anticipated move was 5.3%. Actual move was 1.8%. So we could see that that move was more muted. What about the average? So on average, if we looked at the anticipated moves, it was 5.3%. So 5.3% was the average straddle or anticipated move, and that compares to an average actual move of 4%. So if we took a average of history, then you could see that the move, the anticipated move difference between actual and implied was 1.3%. Okay, so that was the difference between those two. And of course, it doesn't happen every time. You could see here some of these were underestimated. And even just eyeballing it, even when they're underestimated, it could go, the stock could have gone up or down in either direction. It was underestimated because we have two over here that were to the upside, one on July 26, 2022, one on April 25th, 2023, and then we have two here to the downside, October 25th, 2022, and October 30th, 2024, the last. So the move, the volatility, could be in either direction. It doesn't. That's what the data is showing. So over here on this same page, let me see if I can go that on the same page. We also have a summary of some of the option strategies around earnings that are based on the move, the actual move. So how did this straddle perform? So let's say that we did look at the money straddle, and what would have happened if you know, bought the straddle the day before and sold it the day after earnings? Would it be worth more, which would have been, a win, profitable? If it's worth less, it's a loss. And on average, how did they do? Because you could have a scenario where, you could lose 9 out of 10 times, but the 10th time, the straddle could be such a big winner historically that it offset all your losers, right? Or the other way around, when you sell, you could sell and be a winner 9 times, but the 10th time, one time you sold and the loss was much greater than all your wins combined, right? Because the the performance of the straddle could be, anything. It's not always the same amount. So how did the Microsoft straddle do? Let's say you did do it in the last 12 quarters. Just that was the strategy. Bought it at the end of the right before earnings, sold it the next day after earnings. How would that have looked? And here we see that on average, that would have lost 12%. Sometimes you'd make, sometimes you would lose, but the average per trade is down 12%. And the amount of times that it would have come out a winner historically was 33%. Okay, so that's the long straddle. Another strategy, if you want to try to make a wager on the volatility of the stock after earnings, is a strangle. So straddle is if you're doing right at the monies, right? The strikes with the highest time premium. But what if we went for the wings? So the wings would do the strangle, right? You could do the 25 deltas. That's what this is looking at, 25 deltas, where you're saying, okay, I'm going to go for the options that are further out of the money. So I still need a bigger move, but they're cheap. The options are cheaper. How did that perform? So on the long strangle side, which is this strategy here, you could see that was down 22% on average. If we averaged out all 12 quarters, that was also a winner 33% of the time. So even though you could see the win loss ratios the same, the strangle lost more percentage wise because it still required a bigger move on the strangle. What if we did the credit iron butterfly? So what is this credit iron butterfly? Is it's a strategy that looks at selling. So this is going the other way. So this is selling the straddle, right? So you're selling the at the money call, at the money put, but to protect yourself from a violent move, from a very violent move, you buy the wings, right? In both directions. So you're okay. So ideally, if the stock barely moves, it would be profitable because the options that are at the money will decay or drop in price more than the out of the monies that you bought as protection. So how did that strategy perform historically? So here we see that one was on average a winner, 10%. Okay, so that would be your average return per trade over those 12 quarters. How often was that a winner? Well, that was a winner 50% of the time. So half the times it was a loser, half of the times it was a winner. But on average, it was profitable, okay, based on those 12 quarters. So what if we did something a little bit different? What if we said, let's look at it credit iron condor. So this also looks for the movements to be more muted. But instead of selling the at the money and buying the wings, what this does is looks at selling an out of the money call spread and selling an out of the money put spread. Okay, so that requires the stock to move more for you to incur a loss. But how did that one do? Okay, so that's the credit iron condor. So here you see that the average return on that one was positive, on average 6% a positive return. And it was a winner more frequently, right? Because now you got out of the money. The stock needs to move further. So it had a larger frequency of wins, but the returns were lower, 6%. And the reason behind that is because when you on a credit iron butterfly, if the stock barely moves, right, your return is going to be higher because you're selling the meat, the options that have higher time premium. Okay, so those are quick, and we could look at more strategies around earnings, but those are just a quick reference points to get an idea. Oh, Microsoft earnings are coming up. What did it look like in the past? How were the options priced? How did they behave? What tended to be more profitable? What tended not to be? So this gives a little bit of a summary and insights into the past. So here we could see now. Actually, hold on. We have a little bit more time. So what I'll do is, besides these actual moves, let's look at what the implied volatility did in Microsoft after reporting earnings. And this looks at when we look at implied volatility, we have to kind of define what we're tracking, because we can't really look at implied volatility of an option 2 days to go and then compare it to an option that had 10 days to go, or compare it to an option that had 30 days to go, because the implied volatility structure is different as we go out in time. And also we have to define what strikes are we looking at, because we can't compare an at the money implied volatility to a deep out of the money or option implied volatility, because these are they tend to have and trade at different implied vols relative to each other, right? It's not always it's not a straight volatility across the board. The implied volatilities differ. So here we're going to define it as we're looking at the 30-day implied volatility at the money options. Okay, so that's what it's a benchmark of a 30-day constant maturity. And how did that implied volatility tend to do? So here we see that on average, the implied volatility the day after earnings in the 30-day IV decreased by 23%. Right, so the day before earnings announcements, it was 34.2 on average. Then the day after announcements, 26.4. You could see the drop there. And we go out a little bit further to see if this continues to drop, stay the same, tend to go back up, because the next day could be overdone, right? Because what happens is you have a lot of selling of options the next day because people are exiting their positions, or now sellers of options could feel more confident selling because that event, that uncertainty is gone. So does it tend to be overdone, or does it tend to go lower as time goes on, like what is the deal there? How does that look? So here we have an average 5 days later. You could see 23.9. So in Microsoft's case, it looks like that even when implied volatility, drops the next day, it tends to go and come in even more if we go out another week. Okay, so that's kind of, we could even see that over here. This is a table of the observations, for each quarter, and this is the summary stats. So we could see by quarter what the implied volatility looks like heading into earnings, starting 5 days before, what it does, the day prior to the day after, and how does it behave the following week, right? So the idea there is, as people are establishing positions and it's intensifying ahead of earnings due to hedges or people's outlooks or rebalancing of positions, right? So things are starting to, get trading starts to climb, heading into earnings. You see volume usually increasing. What is the implied volatility doing? That's what this is tracking. Then we have, the next day, and then the next week, you'll also have a lot, activity, but slowing down, because then we have unwinding positions, re-hedging positions, establishing new positions due to the certainty of the or the announcement, before it kind of goes back to normal activity, that's not surrounding an earnings event. So that's what this table is, to show kind of the leading up to and leading out of their earnings. And here we could kind of see graphically what the orange is prior to and the green is after. Okay. So we're right up here at the end, Will. I'm going to stop right there.
Hey, D, we did have one question. I didn't want to get in your way as you were going through this. So it's from Cameron, who is a new user. He said, I subscribed for a bit and tried to sell iron butterflies and condors for earnings, and also very high Sharpe ratio directional option spreads, but got caught in a string of bad trades. Do you recommend avoiding very high Sharpe ratios? Was his question. I don't know if that's something you want to look at tomorrow or get your insight today. He was just asking.
Yeah, and I think that, when there are a lot of factors into trading, just besides, just looking at the historicals, and one of the things that, obviously, besides historicals, you need to know, well, what's going on here in the particular stock, and if there's something different, you have to account for that. And I think that there's also, from what I've seen, with what's going on with people, and a lot of the time that you see people lose on stuff, is that the quality of the execution is very important. And as a trader, like, I can tell you, there was a whole, study and section just for quality of execution, which in options is very important. It makes a big difference. Even if you're talking about, it doesn't seem that way to people, but it makes a big difference, because you're talking about high percentages, and as a trader, you're always trying to improve those quality of executions. And I mean, people pay a lot of money for quality of executions. We're paying a lot of money just to be on, have a seat on the floor, and for time and sales, and for those quality of executions. But those become also important. And, for me, I don't see anybody's, how they enter an order, how they manage it, and but that's an important piece that you have to, like, I had, sometimes people would say, well, I want to run a back test, and no matter what I did, I want to see if I went. So if you're you're going out there whacking bids, taking out offers, sending in market orders, putting in stop loss orders. All those are extraordinary expensive. You're talking about such inefficient trading that the statistics themselves, or even the research and stuff, cannot offset such highly inefficient trading. So when
Yeah,
you're
these are multi-leg trades he's talking about too, right? So it's
yeah, so
kind
you're
of,
talking
you're
about
right.
multi-leg trades and
Yeah.
stuff. So if you're a highly inefficient trader, it would be, there's no, even the statistics, you'd have to, pick, winners that are like so exceedingly, which is like an impossible thing to do. So it's important piece, that I see people like ignoring almost, which I could tell you, like, as traders, we focused on that just as much as we did on the research, on the analytics. The quality of the executions are so important that it's something that you do have right now. You know, free execute. Let's say low cost commissions. You have that, but on the other side of that, it's the quality of execution. When you're inefficient, you got to keep in mind why are your commissions so low? Well, your commissions are so low because it is highly likely that your quality of executions, or the way you're inputting them, is so inefficient that the other side of the trade is willing to subsidize your commission. That's how it's set up. That you could look it up. It's payment for order flow. People will pay, brokers, because the quality of the execution, the way you're entering that order is so inefficient that that's making up. They're paying for your subsidizing that what you would have paid for the commission side. Look up. You could look up firms, how much they make payment for order flow. There are public firms that release those numbers.
Yeah, you
And
can look
keep
at
that.
interactive brokers for sure.
Yeah, so keep that in mind, because that is something on a trader. You can't even put that in the analytics, because you can't say, well, he's good at trading, he's bad at trading. His commit. It always assumes that you're going to be making rational decisions and trying to get the best quality execution. And it's very important, and I think maybe we should touch on it more. It's not in the analytics, but as a trader, you have to learn how to do that, and be very efficient trader. So
Yeah, and the Sharp ratio is obviously one tool. Nothing is set in stone, so you got to be aware of
Mhm.
each trade. Look at every
And
trade
then
rationally, and yeah.
exactly, if something seems unusual or odd, and then it warrants more investigation. If it seems like way higher premiums than usual, well, you need to investigate that. Well, what's going on now that didn't happen in history? Like, that's your job as a trader. You have to do those types of research and planning and organizing. Um, it's just part of a trading system, good trading system.
Perfect. Well, we're 2 minutes now into the opening bell. Everyone have
Yeah.
a great day. Remember to like and follow us on YouTube and all the social media spots. Great job as always, D. Everyone have a
Okay.
great day, and